Good Tuesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon live pre-market show. Before we get started, please take a look at the disclaimer. Be aware neither Market Chameleon, myself, or Dimitri are registered investment advisors or broker dealers. If you are looking for professional investment advice, please search out a registered broker dealer. This show is for informational purposes only, concern the Market Chameleon tools and features. With that, take one last look at the disclaimer. And let's welcome Mr. Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. Oh,
Um,
and be aware we have a webinar today at 2 p.m. Stock market contingencies with IBKR. You have to go to their site to register. If you haven't done so already, I'll put a link in the YouTube chat to go over and register.
yeah, so that's today, 2 p.m. Thanks, Will. And I think that this webinar it will be interesting because it's something that it's not really talked about that often. It's kind of a um it's trades and features and orders that are there, they're available, they're like beneath the surface. And I think it will be, just insightful, educational to know about how to use stock contingent orders, how other people are using stock contingent orders, and how to interpret order flow by, you know, um, you know, identifying these stock contingent orders. So I think that it's going to be insightful. It's not something that's commonly talked about. It's probably one of those things that it's happening every day. People are using it. Some people don't know it's available. They don't know how it could be used to their advantage when trading. So we're going to talk about all those um, um, things today at 2 p.m. with Interactive Brokers webinar. And if you sign up, it's not going to be on YouTube like we usually do, because Interactive Brokers is hosting it. So you do have to register with them. Now, for today, if you're joining us for the first time, I'm sharing my screen right now, and Will and I, we do the shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. And if you do have a question, type it into the live chat on YouTube. Will's watching it. He'll read them back to me. And to give you a couple minutes to type those questions in, we'll start out looking at our pre-market report to see if we could get insights, what's going on today in pre-market hours. Then we'll move on to our questions. Okay. So up top here, we're starting out with our pre-market. These are pre-market trading report. And we have this calendar view at the very top and a summary of what happened in the pre-market hours on some historical dates going back a week and what's going on today. And the idea there is that you could compare today's to what's been recently happening in the last week to see how today compares. If you eyeball any type of trends or something unusual, you can go back to a date and take a look at what happened historically. So today we are over here, April 9th, and we could see that so far we have 486 stocks trading higher in our pre-market, 251 stocks trading lower in pre-market trading. We have 130 million shares trading on up volume, 60 million on down volume. And if we convert that volume to dollar value, we have $1.8 billion worth of stock trading higher, $748 million worth of stock trading lower. So looking at it from this perspective, it looks like we're lining up so far for a bullish bias in pre-market trading. Let's take a look at it from a couple more perspectives, then we'll move on to our questions. So I'm going to scroll down a little bit down our page. And now we have a more granular view of what's going on in pre-market hours. We see a list of stock symbols with prices, price changes in pre-market, the volume, alerts, and we have a list of our most active stocks, our biggest percentage gainers, and our biggest percentage decliners. We have 63 stocks that made our biggest percentage gainers list, 30 on our biggest decliners. So that also indicates a more bullish lean in pre-market trading. But to make this list, we do set thresholds because stocks in pre-market can trade with low volume, low liquidity. And if the stocks meet that threshold, you can make it onto this list. And that does include small cap stocks. It could be ETF, it could be a leverage product, an inverse product. And to narrow down this list further to a smaller group of stocks, we could use the filters above. This filter here in my watch list, if you created a watch list and you track a certain group of stocks, you can filter using your watch list. We're going to use this filter in our example, an ETF. And when I click on it, you see that there are different ETFs to select from. We're going to pick this one, SPY, which is the first ETF. And when we did that, the report got filtered by stocks that are holdings in the SPY ETF. So what we did was narrow down this report to the group of stocks that belong to the S&P 500, right? And here we see that 7 stocks made it onto our biggest percentage gainers list. These met the thresholds, and 2 on our biggest decliners list. And that also indicates a slightly more bullish lean in the pre-market trading. We looked at it from a couple different perspectives, and I think they all kind of pointed in the same way that so far trading in a pre-market has a bullish bias. So we gave it a couple minutes. Will, if we have questions, I'll take them now.
Yeah, D, we have a couple awesome questions this morning. So we'll start with my buddy from Naples. He's asking, a friend asked me, why is DJT stock so expensive for short sellers to borrow against? I told him I would ask. It is about 500% APR, the most expensive to short. What determines this interest rate?
Okay. What is the symbol?
DJT. I think that's the SPAC that just bought Trump, whatever them, Truth Media.
Okay. So the question is, just for myself, I'm gonna look at the options chain real quick just to see what that looks like. And then just so I have an idea. So it's a good question. So first, let's describe to people who may not know what this means. Why is it expensive to short? And when we talk about the stock market and you look at a particular stock, well, obviously you could go long it by just buying the shares, but you could also short the stock if you think that the stock will decline. But to short the stock, you need to borrow it from somebody, right? You can't just sell short a stock that you don't have, right? You need to get it somewhere to sell. So you need to borrow it, because otherwise you're just selling what would be like, fake stock. So to sell short a stock, let's say I want to sell short a stock, 1,000 shares. Well, I got to borrow 1,000 shares from somebody who owns it. And then if they let me borrow it, with the promise that I'm going to give them back the shares, well, now I have these shares, right? Now I have these shares that I borrowed, I sell them short, right? And I'm hoping to buy back at a later date at a lower price, right? Sell short. And then I give back the shares. So you need to borrow the stock. Well, the people who own the stock, they don't really need to lend to you. There's no obligation for them to lend to you. They could just hold on to and say, no, thank you, I'm going to hold on. Or they could lend it to you, and they could say, if I lend it to you, you have to pay me a fee, like renting, right? I'm going to lend, like if you own a piece of real estate property and you rent it out, well, they're paying you a fee to borrow, right? They're going to borrow for a year, they're going to live in it, and then they're going to give it back to you. So they're like renting from you. It's like renting somebody's stock, and then you give it back at some point. But that's how selling short works. You borrow stock, and then from somebody, and then you promise to give it back to them. And a lot of this is happening in the background. Really, part of how brokers generate revenue and fees is by they hold your stock in street name and they just lend it out, and they keep the fee. A lot of times, some of them will split the fee with you. And sometimes there is no fee. If they have a ton of stock, they just let people borrow it. And why do they do that? Because they generate, other fees from you trading. So what can happen is that sometimes a stock, maybe this one, Trump media, sometimes there's a large demand to borrow the stock, perhaps because a lot of people want to short it, right? Maybe there was a consensus that, wait a minute, this is too high. I want to borrow this stock and short it because I think it's gonna be low. So as the demand rises and there's a limited supply, right? Just like, like renting, let's say you want to rent a beach house and there's only, 5 available with 100 people who want it, the rents go up, right? The fees go up to rent it. You're in competition. So if there's a competition to borrow this stock with a limited supply, the fee to borrow starts to increase. Okay, so that's why it's going up, because people are willing to pay higher and higher fees to borrow. Okay, and and this is a fee that's charged daily, right? So every day it could change. It could change. I mean, it could change intraday too, but at the end of the day, you're going to be paying that fee, to borrow the stock. And that's why it would go up, right? So this is why the fee could go up, because there's a large demand to borrow. And we could kind of observe this really quickly through the options prices if this is out of line, because remember, with the option prices, we have what's called a put call parity, where you could create a synthetic stock using options. And if the synthetic stock is below where the actual stock is, well, theoretically, you could create an arbitrage. You could buy lower and sell it higher and wait for expiration for them to converge, and vice versa. The synthetic stock is too high, you could sell the synthetic, buy the underlying, wait till expiration till they converge, and then you made a profit, right? And in options, you see here, like right now I'm looking at the May 17th expiration, 29 days to go. And we have the bids and offers and the calls. And then we have the bids and offers and the puts. But something weird is happening with the theoretical value. All right. So when we put in a theoretical value of based on where we think the implied vols are, all of a sudden the theoretical value in the calls are all much higher, and the theoretical value in the puts are much lower than the markets suggest. Well, that means that something about the put call parity is out of line. Something is odd. So It's either we have our interest rates wrong, we either have our dividends wrong, but this doesn't pay a dividend, or there's a large fee to borrow this stock. Okay, so in this case, if you trade a lot, it would be obvious to you that there's a large fee, right? So just by looking, that's what the Black-Scholes model helps us, is to point things out, how the options are lined up versus in theory how they should look, right? If everything's normal, how should they look in theory versus how the actual markets line up. So think of it this way. Whereas the stock was $37.15, right? Well, if I could buy a synthetic, right, below that, below 37.15 and sell short the stock, then I should be able to make a profit, because if I could buy synthetically a stock at, like, say, $35 and sell it at $37, where that's a $2 difference, and at expiration, they both offset, right? But that's great if you could borrow the stock, unlimited amount of stock, and not have to pay any fee. So there's definitely a fee involved here, and the fee is changes from day to day. That's why the Black-Scholes model doesn't even recognize that fee. So there's never a component that said hard to borrow. The assumption was you could always borrow. When the Black-Scholes model was created, the assumption was you could always borrow. There's no such thing as a negative interest rate or fee like that. So you'd have to create like a dividend yield or something. So let's take a look how that would look. So look, in theory, let's do the 35 strike, right? Here's a 35 strike. So if I bought the call and sold the put, that's a synthetic, right? So let's take a look at that. Look, I'm buying the call for 620, let's say, and then I'm going to sell the put, right? So bought the call 35, sell the 35 put. So it's on the same strike, right? Here are the prices. The market price is 620, 965, right? So those are the market prices. So I'm going to run this analysis here, and you could see here, this is the synthetic. This is what it looks like, right? So if the stock goes up, what happens? Well, my call will increase, my put will decrease, but I bought the call, sold the put, right? So at expiration, as long as the stock is above the strike, right, my call keeps increasing 1 for 1. It'll be, and if the stock is below the strike, well, my call that I own is worthless, but my put is going to be 1 for 1 with the stock. So I'm going to be losing on the put that I sold. But it looks like a synthetic stock. Here's the payoff diagram, right? And here's this line over here. That's where the stock is now, 37.15. So notice that one thing is that if we look, at these prices, 620, 965, right? We're buying the 35 call for 620, selling the put for 965. So we're selling the put for more money than we bought the call. Well, do you guys notice something? That the stock is above this. The stock is above 35. The call is actually in the money right now, right? Because the stock is 37.15. The call is 35. The call is in the money. The put is out of the money, right? But the put is priced higher than the call. This is what's going on here. Why? Well, this is telling us that there's a big demand to sell short this stock, okay, or to hedge somebody's long position, right? Maybe somebody, I don't know, maybe somebody's using options to hedge positions for stock that they can't sell. I don't know, but there's a big demand out there, right? And we're seeing that it's priced in there, and that the in the money call is priced lower than the out of the money put on the same strike. You actually get a credit, right? $3.45 credit. He did it here. So $3.45, you're buying, it's like synthetically buying this stock below, right? Below where it's at now, below the 37.15. So that's the fee. That's the fee people are willing to pay, right? For that, for synthetically being short or selling short the stock. That's what's going on here. And here we see it, right? Look right here. If the stock closes at the same price, 37.15, right over here, 37.15. If it, sorry, right? I'm going to try to hover over it. 37. What's happening is you're making like $550, like just if the stock doesn't even go up, right? Just if it closes right here in May, right? If it closes at 37.15 on May 17th, right? Which is, I mean, it's 39 calendar days away, over a month. But if it's here, you're profitable, right? You're already profitable, more than 10%, whatever this is, you could annualize it, but you could see that it's a really big feed that people are paying a lot to short the stock, right? To have a hedge on the downside. And we could look at it even, let's say April 12th, and next, for this week. So even for this week, so I'm going to close this. You can see here, let's do the 35. So here's the 35 strike. Same situation here. It's not as bad, because there's less days, but similar situation where the calls and the puts are, well, let's do it on the 37 strike here, or like right where the stock closed, 37.15. So you could see here the call, which is in the money because by 15 cents, it's priced less than the put, which is out of the money. Right here. Buying the call, 37, buying the 37 call, selling the 37 put. If we run that analysis, we see that we get a credit, 40 cents. Right. And this is where, that's how people are pricing that there's a better chance that this stock will be lower, or it could be, perhaps people who have a locked in position and are trying to hedge those positions through options. There could be a number of reasons, but, obviously here, the market knows, right? What happens is the market knows that there are people locked in, right? Right now, the market knows this. It's information, right? So what are they doing? They're using that information, knowing that there could be a lot of stock unlocked at some point in the future that's going to create pressure, right? And they're anticipating that pressure could, drive this stock much lower, right? So whatever IPO'd so far, is a certain supply of stock, but there's a lot out there in the sidelines, right? And they know when the unlocking period is going to begin, and they probably can anticipate that there's going to be much more supply, and maybe even a need for those people who get over that unlock period to have to sell.
Yeah, well, there's a potential need out there because the acronym DJT is obviously Donald J. Trump, right? And he's got all sorts of things that he's going to have to pay probably money for. So
right. Does he have to sell stuff? Right. Because right now he can't, right? But at some point, that whatever it is, you got to go read the terms, whatever it is, but that's what traders are doing. Right. You're trading information, right? And they can anticipate, like, yeah, here's the dates. Here's the amount of stock that's available right now. Here's the amount of stock that's locked up that will become available. And those shares are likely to create pressure, and and there may be a need to actually sell those, right? Once they get unlocked, there may be a need to actually sell those shares in the open market. So that's, things to start considering.
Now, when they're locked up, I remember there was decades ago when we were on the floor and Mark Cuban sold his company to Yahoo, and he had a lockup, but he was able to go into the options market and hedge his stock position. And
It's possible, yeah, it's possible that that's happening. I'm not sure like what the rules are with that right now, but it's possible that that's happening. That there's some hedges going on there. There might be some over-the-counter insurance that's being developed and hedging in the open market. So there's lots of possibilities here. Let's just take a look at the open interest here. So you could see here's the big open interest is here, April, right? April 19th, you could see a huge amounts of puts, but even going out Jan 17th. So, pay attention to what you're doing, seeing what's going on in the market. You got to learn it, look at this to me is what I believe is going on, is that they're looking at that lockup period, that date, and the need for stock to be sold, or somebody's hedging. Again, somebody might be hedging this against position. So we're right up at 9:30. Will, I'm going to stop there. As a reminder to everybody, 2 p.m. today, we're going to be with Interactive Brokers. We're going to be talking about stock contingent trades. It's a new feature also that we just pushed out. It's part of our multi-leg trades feature. So, we're going to be going over that. And I hope to see you guys later this afternoon. If not, maybe tomorrow.
Yeah, we did have one outstanding question that we'll get to tomorrow from Doug. It came in after this question from the mayor, and he said, Will, if there are no questions, can we have the look at the new update for price action trader hour VWAP? I find it enhances my trading edge. So maybe tomorrow we can look at that new feature.
Yeah, let's
cool.
do that. Okay.
All right, great job, D. As always, we'll see everyone hopefully at the IBKR webinar if you can make it at 2. If not, we'll see you tomorrow. Thanks, D.
Yep. Thanks, everyone. Have a good one.